Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com. Hello and a warm welcome to Econoday Unplugged on Tuesday, the 11th of January 2022. Terry Sheehan is on the US East Coast and I'm Jeremy Hawkins in London. Well, it might not have been a full-blown taper tantrum, but financial markets' response to the FOMC's December minutes was hardly a happy one. The subsequent jump in US yields warns that the prospective combination of rising interest rates, declining Fed asset purchases, and perhaps crucially, a surprisingly early shift by the US Monetary Authority to quantitative tightening, in other words, outright asset sales, leaves a decidedly vulnerable outlook for fixed income markets. In fact, with a number of other central banks, including the Bank of England and the Bank of Canada, having already terminated their QE programs, even the likelihood of lower inflation in 2022 might not be enough to ease bond investors' nerves about falling central bank purchases. And of course, all this comes at a time when COVID cases around the world are at record highs, climbing as sharply as ever, and threatening to add to the inflation pressures caused by global supply chain disruptions. So not the smoothest of transitions into 2022 for financial markets then. So Terry, I guess we should start with the FOMC minutes, because clearly it seemed to be anyway a good deal more aggressive than some investors are anticipating. Were they really as hawkish as that, or perhaps the people got a bit carried away with them?
I think it's a bit carried away. This is something that, although they will taper the purchases, I think quite quickly by the end of the first quarter this year. Outright sales are probably further off, especially since markets reacted so adversely to them, to even the hint of it. I think probably what's more concerning to many is the increased anticipation of rate hikes in 2020. Some people are even talking as many as 4. So I think actually Chair Jerome Powell is going to be having his confirmation hearing for his renomination as chair today. So I think we may hear more about that there, because it will definitely be on the minds of the Senate Banking Committee members. But given the deep concern about inflation and inflationary pressures developing, I think we are definitely going to see a more hawkish lean in Fed policymakers this year.
Okay, fair enough. Let me ask you, stemming from that, I suppose, we saw the benchmark 10-year Treasury bond hit its highest level in nearly 2 years on Friday, and that was after a weak employment report, or at least what appeared to be a weak employment report. So can we just address that quickly as well? December employment, it came in at less than half the Econoday consensus on the payroll. Was it that weak, or is it just a one-off, or how do we interpret it?
I don't interpret it as that weak a report. It was certainly a disappointment, especially in light of the upwards of 800,000 private jobs that were in the ADP National Employment Report. But the two don't tend to move closely together. In addition to the nearly 200,000, there was also an upward revision of substantial size to the prior 2 months. So we were actually dealing with something that was around, just below the 400,000 in the market consensus. So it really wasn't that bad. Certainly, it's just 1 month's data. We would really need to see 2 or 3 more months before we could actually say that the hiring trend had slowed down significantly. But there was also some good news in the report in terms of steadily rising average hourly earnings. There was the unemployment rate dipped below 4%. The U6, what they includes more marginalized workers, was also down substantially. The size of the labor force is growing as marginal workers on the margins start to come back in. So there were a lot of good pieces of news in there. I would say this was really more 1 month's data, and unless we see a weak January, which I would be surprised to see, I am not overly concerned about it.
Okay, fair enough. I guess a lot of it boils down to what it all means for inflation. And tomorrow, isn't it? Wednesday, we'll get the December CPI update.
Yeah.
What are we looking at there?
Well, energy prices actually were falling in December. So some of the pressure from that may be relieved. The other thing is there are some signs that some of the upward price pressures seen in manufacturing have eased up a little bit, less so in services. So I think we're probably going to see an uncomfortably strong report tomorrow, but not one that would suggest that there's an acceleration in inflation. In fact, I think we're going to see something that would suggest it's easing off just a little bit.
Okay, fair enough. Right, before we get anything else you might want to put into the pot, if I can ask you first about what's going at the Fed in terms of personnel changes. We do seem to be running out of Fed governors at the moment. I see another one appeared to disappear yesterday. What's going on, and what's it actually mean for sort of the thrust of Fed policy as we go through 2022?
Well, Richard Clarida, his term as governor would have expired at the end of January. So he was in all likelihood on the way out, because it's unlikely that the Biden administration would have renominated him to a fresh term, being a Trump appointee as he is. But he's leaving as of January 14th, which means he won't be there to vote at the next FOMC meeting,
Right.
Which means there will only be 4 of the 7 possible governors to vote next time. It also means that the Biden administration now has a clear 3 vacancies to fill, and hopefully they will nominate these people soon. We were hearing back at the end of December that we were going to hear the names any day now. Still haven't. The one thing about Clarida's resignation is that it removes any murkiness from the nomination of Lael Brainerd as vice chair.
Okay.
So that is, the current vice chair is leaving. So yes, we will definitely need a new vice chair. But it also means that the Board of Governors is without a vice chair and without a vice chair of supervision. So those are big things. And we still have 2 district bank presidents who need to be appointed as well. So there's probably going to be some fairly substantial changes at the top of the Fed.
Can I ask you, probably might seem a strange question, but if they were to have some more resignations or whatever, is there a flaw to how few a number of Fed people can actually vote when they're making a policy decision?
Okay, well, with the FOMC, all governors have a vote. If a governor's seat is not filled, then there is no vote for that. But for the district bank presidents, there is a rotation of alternates. So there are always 5 district bank presidents voting. But how many governors are voting depends on how many governors' positions are filled. So this time around, we're going to have 9 votes for whatever the policy decision is at the next meeting.
Okay, interesting times. Right then,
Yep.
anything else from your side before I shift across to Europe?
No, I think I would say as a sort of a footnote to Fed policy right now is I think when Fed policymakers talk about having met the conditions of inflation and employment for starting to lift interest rates, I think we are getting closer to those conditions. But whether they actually start raising rates then or not is in question.
Watch this space. Okay, great, Terry. Thanks a lot for that. Okay, to my sort of part of the world then, I guess as quickly I should kick off with I can't say good old Omicron, but sadly, the Omicron variant, record cases right across the European Union as we record this. Indeed, they're up about 3.5 times now the previous peak we saw back in early November 2020. Although by and large, as we've talked before on the podcast, it doesn't seem to be as serious, at least medically serious, as the likes of the Delta variant. It is going to hit output in terms of people having to self-isolate and so forth. And it probably means it's going to make something of a mess in terms of the first quarter economic data. Putting that on one side, following on from Terry talking about FOMC policy, with regards to ECB, we've had the ECB chief economist out yesterday, Philip Lane, still towing the line that an interest rate hike coming out of the European Central Bank is unlikely as far as 2022 is concerned. So they're still working with the view that even though they do expect a reasonably decent economic performance from the Eurozone, from Eurozone GDP, they expect no change in interest rates. They also reiterated the view that net asset purchases will stop shortly before the first interest rate increase. Well, if they're right, that's going to happen this year anyway. And in terms of actually shrinking its balance sheet, so quantitative tightening, going out and outright asset sales, they're not really looking about that happening until sometime after interest rates have begun to be hiked. So to all intents and purposes, as things currently stand at the start of this year, there's nothing particularly new that we know that's different from the last meeting in December of 2021. However, what has changed is that the ECB will no doubt not be particularly happy with the backup it's seen in its bond yields, sovereign debt yields. Bund yields, 10-year bunds, are up about 33 basis points now since around about the middle of December time. That's the highest they've been since April 2019. Italian bonds are up about 47, 48 basis points. So not only are yields rising, but we're also seeing spreads widen out as well. And that's clearly going to help to undermine the favourable financing conditions that are seen so keen to ECB policy. The emergency purchase programme for the pandemic, that may be on its way out. It's due to conclude at the end of March. But it's going to be interesting to see whether or not pet purchases are actually stepped up this month, given what's currently going on in the fixed income markets. In terms of where we go from here with regards to interest rate, there were some interesting comments coming out of Isabel Schnabel, who's one of the executive board members from Germany, who typically is regarded as being, despite being from the German side and perhaps most expected to be on the hawkish side of policy, she's normally regarded as being a fairly good sort of intermediate, medium-term indicator of where policy might be headed. And she was talking quite interestingly yesterday about, I suppose, risks stemming really from the Paris Climate Agreement. The bottom line saying is that the energy transition as we go from carbon into more and more green, it may lead to inflation simply remaining higher and for longer. Now that may be more of a medium, perhaps longer term issue, but nonetheless it does give you an idea of how the ECB is starting to think. Yes, the current thruster policy is very accommodative, no change. But if we do indeed see some of the structural shifts in the way fiscal policy, climate policy is operating, really perhaps not just in Europe, also around the world, it could actually lead most definitely to higher prices, which will make it all the harder for central banks to cut interest rates in the future if they see fit. With regards to the real economy coming out of Europe, it's still relatively sluggish. The industrial production figures out last week showed surprise falls, not big ones, but falls coming out of both France and Germany, so the two largest members of the Eurozone. Still seems as if manufacturing will give a small positive contribution to fourth quarter Eurozone GDP, but don't expect too much to come from it. More worrying, as mentioned, the big increase in Omicron cases, well, that was reflected in the PMI data for December. Notably in the services sector, That PMI came in at just 53.1, which is the weakest number we've seen there since May. And indeed, we look broaden that out to the Economic Sentiment Index compiled by the European Commission. That showed morale in service at its lowest level since April, and at least as importantly, its steepest monthly fall, best part of almost a couple of years. German services, the PMI there, actually signalled an outright contraction. So it really does seem as if fourth quarter Eurozone growth could be well down on the quarterly 2.2% rate they came out within the third quarter. So start to sort of this back end of last year and probably the start to 2022 for Eurozone economic activity ain't going to be too much to write home about. Inflation, meantime, well, that's actually stayed surprisingly high. The flash numbers for last week, the HICP, that came in at an annual 5.0%. That was only up a tick from last time, but it was a couple of ticks above what the market was expecting. But I guess the good news there, it is actually showing signs now of topping out. And indeed, just due to some technical changes, crucially the falling out of some of these modifications we've had to German VAT, that should almost certainly lead to a decline in headline inflation when we get the January numbers coming out, unless we see energy prices really take off again. Anyway, pull that lot together. Shouldn't be too much new really coming out of the ECB meeting. Next one's on the 3rd of February, bar what they have to say about what's going on in the bond markets. As far as the UK is concerned, it's a pretty quiet period for UK data this week. But I guess it's worth pointing out the government here is sounding increasingly confident that despite near record cases, they do appear to be coming down now, particularly in London. Omicron does not appear to be as big a concern as originally thought, and the government's now trying to describe it as much more as being endemic rather than being a pandemic. And the shift there could be important for next month's Bank of England meeting, since we start to get more positive words coming out of the government about the coronavirus. It will make it easier for the Bank of England to hike interest rates again, which markets by and large are just about discounting at the moment. It looks as if they're looking for around about another 10 basis point hike. Also on the February the 3rd, the Bank of England's first meeting of the year. Anything else? I guess I also mentioned some of these ongoing Downing Street scandals, which really has had very little impact on the pound. Sterling is trading very strongly against the euro. We're almost at 120 at the moment as we record that. And that's despite the fact that there's been reports of yet another Downing Street party, which took place during the lockdown in 2020, putting more pressure on the government, and particular additional pressure on Prime Minister Boris Johnson. There seems to be increasing calls, or speculation at least, that he may have to step down at some point. And certainly if there were to be a leadership challenge, sterling at current levels was suddenly starting to look very vulnerable, particularly if we weren't to see UK interest rates being hiked again. Mention quickly Switzerland. On last week's podcast, we talked about the SNB, Swiss National Bank, appeared to be standing back from the market despite the fact its currency was getting ever stronger. Looking at some of the weekly financial data, it does seem as if they've actually been intervening a little bit more heavily over the last few days or so. But nonetheless, our big picture still seems to suggest now that the Swiss monetary policy has simply learnt to accept that the Swiss franc is going to be stronger than they want, and they're kind of stuck with it. But it's a currency to keep an eye on at the moment. Round off with Canada. Terry talked about US employment report. Of course, last Friday, we also had the Canadian numbers also out for December, and they were unambiguously strong. We saw an increase of almost 55,000 in Canadian employment. That was pretty well double the market expectation, and that was more than fully accounted for by full-time positions as well. So by and large, it looks as if Canada, again, question marks over the Omicron because numbers there are bad too, but underlying Canadian fundamentals look to be pretty good. So it does seem as if we will see interest rates going up, perhaps in the first half of this year, perhaps as early as April, as far as Canada is concerned. And lastly, on the interest rate front, this week we'll get the Bank of South Korea, their central bank meeting. They were the first out of blocks in terms of rate hikes back in August of last year. They've done 2 so far this cycle. Could tighten again on Thursday, so keep an eye on it, although the consensus is it's probably steady for the time being. Okay then, so let's call it a day for this week. On behalf of Terry and myself, thanks as always for tuning in. We'll be back next week, and in the interim, remember you can always keep track of the key market moving data and events in Econoday's super user-friendly global economic calendar. We hope to see you next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.